Good afternoon, folks. Welcome back to another episode of U.S. Home Talk. I'm your host, Mike Overson from Luminate Bank. In the show with me today, got co-host Jason Walgrave, Walgrave Real Estate Group, RE/MAX Advantage Plus, and no stranger to the show, another co-host, Marcus Walgrave, South Dakota Home Team, powered by Hague Realtors. We are your real estate and mortgage podcast, answering your questions, talking about current events in the mortgage and real estate world here in the upper Midwest, where we're all located at, and across the country. On the show with us today, we have a guest who is no stranger to the show. He comes from Arizona, is where he's located at right now. We got the Yoda of real estate, Mr. Steve Perkins. Welcome, Steve.
Good to be with you.
Hey, Steve. Good to see ya.
Good. Yeah, it's a little warmer here, I bet, than it is.
No,
there, but,
same time.
You're having pretty nice weather too.
Steve, how's the ice fishing down there in Arizona?
Well, it's pretty thin, but one morning I could see just I think it was either some ice that formed or it was an ice cube that I threw out from my beer that I was drinking.
Okay. Yeah, sounds like the ice fishing is a little slow down there this time of year, huh?
Slow.
Well,
but
maybe
if you get in northern Arizona, then there could be there's snow up there, skiing and stuff. So
nice. Well, we're talking today. We like to bring the Yoda on the show because he's seen it all. I mean, he came over on the Titanic. He saw electricity get invented. He's been doing the real estate thing for a super long time. And so he has all this experience. And to be honest with you, we have previous shows where me and Jason and Marcus are trying to predict interest rates, what's going to happen, and all this and that. To be honest with you, the one person that I have stayed in contact with on all of these interest rate predictions that has been the most accurate has been the Yoda. It has been the Yoda. So you're my crystal ball, Yoda, when it comes to interest rates. I ask you, that's my crystal ball that I look into to try to predict them.
and sometimes there isn't an answer.
Sometimes there's not. You're right.
Right.
So we're talking about quantitative easing today, right? That's the hot topic in the mortgage world, right? Trump came out last Thursday saying, hey, great news. The housing affordability was one of the things I was talking about, and I'm keeping my promise. I'm going to have the federal government buy $200 billion worth of mortgage-backed securities, which is going to help interest rates come down, okay? That's called quantitative easing. So that is the hottest topic that we have had in the mortgage industry for a while, right? Because that's pretty big news. We've seen it in the past, and so therefore we have, kind of an inkling of what's going to be coming up here in the future. But Steve, with that news coming out, with interest rates sitting in the low sixes, high fives, low sixes right now, so let's just say 6% flat for all practical purposes. What's your kind of prediction on what's going to happen with mortgage interest rates in 2026 here?
Well, I've read a number of predictions. Some people say it will do nothing if and this isn't the Federal Reserve that would be buying these, as I understand it. It would be Freddie and Fannie that are used to be government entities, and now they've been kind of shoved off into the private sector almost a little bit, but that buy all these mortgages and stuff, and they have excess cash, so that they would be injecting about $200 billion into the mortgage market. And I guess that's about 1 month's mortgages, that come into the market. So would think that would have some effect on it. If you buy these loans, that means that there's more people that want to loan this money, so therefore interest rates would drop, and it would be a quantitative easing. Again, why people would say it would have no effect, I don't know, but I don't think it's not going to lower them a whole percent. Plus, they do it one time, and after a few months, it kind of equalizes again too.
So does it matter? Like previously, was it the Federal Reserve that was buying the mortgage-backed securities?
Well, what we really saw during COVID is of course, short-term rates. That's what the Fed normally does, is overnight rates, and they set those, and they were so low, they were basically zero back, and this is kind of the COVID days, if you recall. Mm-hmm. And of course, then home loan rates were higher, and what they did to lower those down into the about 3%, was it? I borrowed some money at 3% on a 30-year basis. Is they simply bought long-term loan treasuries, which basically fixes into the home loan market. They bought those, that lowered those rates, and then they sold very short term. So to the Fed, it was an equal. They called it, it was neutral to the balance sheet, neutral assets, liabilities. I mean, you sell something and then you buy something, and so that's equal in the same amounts. And so it tended to raise short-term rates, which were already zero, and it raised a minuscule amount. But then it brought down these long, and they were doing that to the tune of, I think that was about 100 billion or so a month. And so that had a tremendous effect on lowering long-term rates, home loan rates, and things. This is different than that because it's just one-sided, and it's not to the degree. It's not a consistent thing. If I think the president was able to say that we're going to buy 200 billion a month, if that's what they're going to do it in for several months, then that would definitely lower rates. But the yield curve is not just too bad right now anyway. I mean, by the yield curve we mean what's a 2-year Treasury note going for, and what's a 10-year Treasury note going for, or a 20-year Treasury note, and you normally should have some increase in that because otherwise, if it's lower in the future, that kind of signifies not a very good economy is coming forward, maybe a recession or something. So. I don't know. It will be interesting to see what happens. Obviously, it will have an effect, though. You can't put $200 billion, if that's what he was directing them to do, and that's what I've read. You can't put that into the mortgage market and say that it won't have any effect. I mean, it's got to have some effect.
Right, Steve. That was kind of the big question that I had when he announced that he was talking to his representatives to purchase the $200 billion, and when they were. To your point, a different entity. The Federal Reserve was doing this during the early 2020s, and my question to myself was, how much were they buying in the early 2020s? And you answered that. So about $100 billion a month, but consecutively doing that over, was it 12 months or 18 months? I don't.
It was over 2 years.
Yeah, so 24 months of $100 billion, so 2.4 trillion. Over the 2 years,
some months it wasn't always 100 billion. It was maybe a little less than that, but it was constant. And again, you're buying something and selling something. So to the Fed's balance sheet, it didn't make any difference. Now some people say, "What the heck's a balance sheet?" Well, you got assets and liabilities, and if you take some assets in for $100 and you take some liabilities in for $100, it's a negative effect on the bottom line. But
and then they started selling those in 2023.
That's correct.
And that's kind of, Mike. I mean, that seems to be aligning right when we saw the rates start shooting up, and everybody saying, "Whoa, what's going on here?"
Yeah, right. Exactly. Yeah. So the timing of all this is kind of uncanny, right? And it all plays into each other because that's how economics work.
And we were also then seeing kind of inflation in housing. I mean, as you guys on selling, you saw those house prices, they were rising, right? Pretty good. Right. I mean, it was pretty good. It made for a good investment,
Yeah, big time.
Yep.
You could borrow money at 3%, and gosh, the darn thing, the value of the house, in particular, if you did something to it, might go up 3, 4, 5% a year. So,
it
didn't take too much math in school to learn that would be a pretty good deal.
Right. Don't need to take calculus with Lauren Carroll back at Laverne High School to figure that one out.
Exactly right. Yeah, exactly. Even a little third grade arithmetic would tell you that.
Right. So we're gonna talk about the immediate effect that had, because that happened last Thursday. There wasn't an immediate effect in mortgage rates. We're gonna talk about that coming up. But first, we're gonna go to a legal minute. When we come back, we're gonna talk about the effect that it's had on the mortgage market already.
This is Jeff O'Brien, attorney with Hush Blackwell with the U.S. Home Talk Legal Minute. When you sign a residential purchase agreement in Minnesota, whether you are the buyer or the seller of a home, your realtor will likely ask you whether you wish to sign an arbitration agreement. Arbitration is the submission of a dispute relating to the material facts of the property to one or more impartial persons for a final and binding arbitration. The arbitration is a private dispute resolution system offered as an alternative to the court system. It is not government-sponsored. If you agree to arbitration using the Arbitration Disclosure and Residential Real Property Arbitration Agreement, you must use the services of the National Center for Dispute Settlement. The parties select an arbitrator from a pre-approved list, submit written evidence, and participate in a hearing which could be in person or conducted over the telephone, depending upon the circumstances. Upon hearing all of the parties' evidence and arguments, the arbitrator renders a decision, and if the decision finds that the monies are to be paid to a claimant, the arbitrator makes an award. While the use of an attorney is not required in arbitration, it is highly recommended. This is Jeff O'Brien, attorney with Hush Blackwell, with the U.S. Home Talk Legal Minute.
All right, thanks, Jeff, for that. Appreciate it. We've all know the arbitration thing. It's on every purchase agreement, right?
Yes, it is.
In Minnesota.
In Minnesota,
We do
that's right.
not
You
have
don't.
arbitration in South Dakota. We do offer mediation, but those are definitely different things.
Okay,
So arbitration
interesting.
in Minnesota is required by
No.
statute or just
No, not required.
tradition?
It's not required in Minnesota. It is. It has to be offered. You're required to offer it in a real estate transaction, but not required to do arbitration.
So the seller or the buyer basically could say, no, I don't want to have arbitration.
Yeah, anybody can. The buyer, the seller, either one of the agents, all parties need to agree to it in order for it to be in place.
Wow.
And we don't, as a practice, we don't generally recommend arbitration. The thought behind that is you're giving up some of your rights. You don't have the ability to, be in front of a jury if necessary, although unlikely it would ever go that far. But so we have over the years we don't recommend doing arbitration for our clients.
So getting back to the quantitative easing and the immediate impact on the mortgage market, mainly interest rates, from the announcement from Trump last Thursday, rates have come down about 1/8 to 1/4 since then. Okay. So there was an immediate reaction. It was a positive reaction. Interest rates came down. A lot of people, if you were at that 6.125 mark on your interest rate last Thursday, today you're at 5.99, right? Now you got a 30-year fix that starts with a 5, baby, right?
Love it.
And
Love them
was-
fives.
Marcus, was it you that sent out the Homes.com report saying that
No, that was
mortgage ac-
Jason. That was Jason. Yes.
So then Jason sent something out saying
35%.
that mortgage demand has gone up 30% or 35%
Yeah.
since the announcement, which I replied and said, it kind of makes me laugh because interest rates only went down 1/8 to 1/4. It's not like,
Right.
it's not like the bottom fell out. But again, it's the media saying, hey, this announcement came out,
Yeah.
interest rates are better, and it's just like, look what happens, right?
I thought that was a fascinating number, 30%. Mortgage applications up 30%. I mean that is massive. And like you said, Mike, if it only went down 1/8 to 1/4, imagine if it went down to 5.5.
Right?
I mean,
And there
buddy,
wasn't anything else that
Holy
you could
buckets.
that would explain
hold on.
This spring already up here, and we know in the upper Midwest, right? We know our stats like the back of our hand, and I'd be curious to get Steve's take on what the inventory and stuff looks like down in Arizona and the activity in Arizona. But up here, I mean, a 5.99 interest rate going into what we consider our spring market, pretty much, the Super Bowl kind of marks the start of the spring market for us up here. It's like everyone watches the Super Bowl, and now if you want to buy a house this year, you're on the streets looking the day after the Super Bowl is done, right? And it's like that back half of February, March, April, May are just busy and bonkers, right? Now, if we get rates if the rates stay where they're at now, let's say it's a 5.99 rate that you get, right? We are going to be as busy as we want this spring. If our rates are at 5.5 or even a little bit lower when we get to that point, we're going to get no sleep. We get no sleep.
Really?
All three of us will get no sleep this entire spring.
Sleep when you're dead.
Yep.
Well,
So-
and that probably has a lot to do with the, how the economy is. People are perceiving the economy and things happening, but it isn't just interest rates or what. I mean, that would be my question to you guys. It's certainly
No.
a big factor, but
Yeah, I think that's a great point, Steve. I think that it's probably the biggest factor right now is those interest rates going down. But yeah, how the economy is doing or the perception of how the economy is doing. I always, to get an indicator for myself, I like to go out, to a restaurant. How busy is it? Or you go out to Costco or Sam's Club on Saturday or Sunday, and it's like, oh my god, this place is packed. I mean, there's nowhere to park in the whole parking lot. I mean, people are, so you can get a feel for how the general public feels about the economy by just going out.
And at the same time, last week, I mean, the stock market hit all-time record highs.
Yes,
So I mean,
yes.
the Dow and I think the S&P and so that signifies. I mean, a lot of people they don't
Sure.
pay any attention to the stock market because they don't have any money in the market, or their retirement money is there, but they don't really watch that probably that much. But I mean, still, it's
Yeah.
the whole economy.
Yes.
People with money and that's really what it is. It's you got to have a ball to play if you're going to play the game, and if you don't, well, it doesn't really make it too much difference what you think. So if you don't have any money, you're not buying homes, you're not investing, you're not doing anything. But investors, we're certainly looking and saying, hey, we think that the 2026 is going to be a pretty good year, and if that carries through to home buyers, then people are more, hey, let's go buy something.
Yep.
They feel comfortable about doing it. So.
Yep, for sure.
Yep. I'm expecting a busy spring. I mean, I think the kind of the gist of it here is that it's a good thing. Quantitative easing is a good thing for mortgage interest rates. We expect them to drop slowly. How far do they drop? I don't know. Your guess is as good as mine there, right? This time around is a little bit different. I don't know how far they're going to drop. We've had a nice immediate reaction where they've come down a quarter, and it's clearly sparked a bunch of activity if mortgage demand has gone up 30% since the announcement came out. Right?
Well, yeah, and I would just say, again, going back years and years and years, I mean, I saw in real estate very active, sales markets for homes and stuff at 7 and 8%. And in fact, historically, if you want to go back 100 years, I mean, 7-8% is much closer to the average of what was most of the time than 6. And clearly, people out there that think that we're going to see 3 and 4%, I mean, maybe if we have some big recession or something, but that's just not likely. So if you're waiting for that, you might be waiting an awfully long time, maybe your children
forever.
might not even see that again. I mean.
I think you're right,
But-
Steve. I don't think we'll ever see threes.
But interest rates are movable. I mean, in my short lifetime, I mean, I can remember selling homes at 17.5%, and didn't sell many, and the prices definitely decreased. And then I've seen 3%. So,
Good range.
and I'm old, but I'm not that old guy.
You still got a good
I think
100 years
the
left.
builders are going to be
Exactly,
excited about
exactly.
2026.
I mean, that's right, Mike.
What was that,
Yeah,
Marcus?
Good point, Marcus.
I said I think the builders are going to be excited about 2026. I mean,
Yeah.
they're seeing those construction loan rates come down. The consumer, if they see anything in the 5s, they're getting super excited. So that might tell the builder, hey, you know what? I might throw another spec out there, maybe 1 or 2 more than I did last year, just to get that inventory up there. If you got a pre-existing home, you're in that 3.5, 3.75 rate, and you see that you can maybe pick up a 5. Maybe a 5.5 later this year. Those individuals might be willing to part ways with their high 3% rate and get the house that they actually want, and be happy with the 5.5 or whatever
Yep.
it is.
Yep.
Well, and I would say just this little decrease in interest rates, which is a combination of things. I mean, Trump announcing that had an effect on it, but I doubt, and I was trying to ascertain, have Fannie and Freddie, I don't think they just went into the market on Monday and just bought $100 billion each of loans. Boom. I mean, no, that's going to be coming in over a period of time, and that they will be doing it. And so the market was reacting to that, and so I think we'll see the effects of that for some time. So
They just write a personal check for that, you think? I'll take
Straight
probably
cash,
so,
homie.
I'll take $100
Straight
billion.
cash.
And just 100.
How many zeros is
Straight
that?
cash.
Starter
Exactly. They
checks.
called me up and asked, if they.
Starter
And I
checks.
said, yeah, just do it. What the heck. But,
You only live once.
And the other thing we have to think about our economy is certainly in the Trump thing, deregulation. I mean, a lot less regulations in the economy. So if you're a builder, and that kind of filters through even into the state and local levels. You might find yourself maybe easier to subdivide, or easier to maybe some of those prices will diminish. Clearly, energy has dropped quite a bit, and that's a big thing. And every energy goes into everything.
Sure. Yeah.
So I think apparently the market's looking 2026 is pretty good. If we get this quantitative easing, that will help to drop mortgage rates. It's probably a pretty good time, to buy.
Yep. We're expecting a busy spring for sure up here. And I do expect rates to slowly float down. I don't think the bottom's going to drop out. Some people are, might be thinking that, but I don't think the bottom's going to drop out. And I don't even know if we get to the low fives because of this, to be honest with you. But if we can get to 5.5, even 5.5 costing you a point, costing you one discount point, I mean, we're going to be as busy as we want to be. That will spark a lot of activity, and I think it's going to be a busy 2026.
Well, and if something happens that interest rates really drop to 4.5 or something, then we have a thing called refinance, right? I mean, and you can do that.
Then Mike
you'll be
definitely
doing
won't be
refis.
sleeping.
You'll be doing refis right now at 5, certainly at 5.5.
I'm doing plenty of refis right now.
Right now at 5.99.
At the current rates now, and then if they continue to go lower and stuff, then I really won't be getting any sleep, and I probably won't even be able to do these shows anymore, right? I might have to do the show. I'll be writing a refinance over here while I'm doing the show, like, multitasking. It'll be like that type of market again. So,
The old days.
The good old days. That's right. Well, we appreciate you being on the show, Yoda. We
Thanks,
appreciate
Steve.
the listeners joining us for U.S. Home Talk here again. We'll be back for another live show on Wednesday, next Wednesday at noon. Feel free to reach out to us at any time during the week. USHometalk.com is the best place to connect with us. You can listen to our past shows and connect with us and all of our preferred partners there. Again, USHometalk.com. Thanks for joining us. We'll see you next week.